Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Hi, good everyone. How you going? Thanks for joining us on the podcast today. We're heading out west. Well, that gives us some sort of geographic reference, I guess, for where I'm recording from the eastern seaboard of Australia, New South Wales, specifically North Sydney and Sydney. So heading out west across this great brown land out to Perth, which has been getting a lot of interest of recent after what has been probably at best a bit of a lackluster decade in the West. Things are firing or starting to fire in terms of property markets, and whether that's just a decade of very flat growth, just catching up and finally moving into the gear, or it's something very differently. I'm not too sure. I'm trying to navigate a whole bunch of conversations around WA. I know a lot of buyers agents, particularly in the resi space, are heading out that way and considering. And I did note watching the television the other day, I think those based out in Western Australia, they call Western Australia home, are the happiest in terms of their government with the performance of the government out there over the COVID-19 environment. So whether or not that's got anything to do with property markets shifting the gear, whether it's the resource sector is supporting that or a whole bunch of other macro and microeconomic factors, we're going to get into it today. Joining me in the studio, Brian Sullivan, Managing Director of Brian Sullivan Property Consultants. He's a commercial specialist. So we're going to get into commercial property in WA, particularly Perth, and maybe get some views and observation because there is this intersection between resi and commercial in terms of how property markets are performing and the wider economy. Brian, how you going?
Welcome. Yeah, very happy to be here. Thank you.
So you guys have had it pretty tough out that way for the last decade or so. Are people walking down, what's the main street? George Street with their chest,
St. George's Terrace.
Their chest up with a bit of swagger in their steps now?
Yeah, look, a little bit. Yeah, we feel fairly buoyant over here would be probably the best way to put it. And there's a little bit of confidence in the air, and we're feeling pretty good about ourselves, I suppose. And it seems to resonate through the community.
What's going on? Why is it so different?
Oh, look, when it's so different, we haven't been able to travel to see those differences firsthand for a while. But we think we've got a fairly buoyant mining industry. We can see that our figures and our economy are doing pretty well in comparison to the west of the country and certainly the rest of the world. Being a very parochial Western Australian, I've been here for a long time, and I've got the view we've got a very strong future. And typical of most Western Australians, they just want to get out there and give it a bang, give it a go. And that sort of attitude does serve us really well over here. And that's the general feel of the town. I mean, you can't say it's all beer and Skittles. There are obviously a lot in the retail industry in particular and other industries that are doing it very tough. But there is a general view that we're going to overcome this. We have overcome this. We're on our way now. So it seems to be the start of some confidence.
Yeah, and I'm seeing it. I'm reading that across some of the property data I'm seeing coming out, economic forecasting about WA. And, you're very fortunate out that part of Australia to have plenty of stuff on the ground that you can dig up and sell to people, and that's a big driver of the economy. Can you give me some sense for how connected you feel property markets are in Western Australia with the performance of mining? Are they two peas of the same pod? They don't really act or operate in difference to each other, like they're highly linked and connected.
Oh, we are. You know, we used to say we rode the back of the sheep's back in this country, but over in WA, from my point of view anyway, we're very heavily connected to the success of our mining industry. We're very boom-bust orientated, or we have been in the past, and it has been around that driver for a substantial period of time.
What's kicking mining along at the moment? Because, a lot of people invested out early 2000s way out WA as the mining sector went through its build-up phase, so a lot of construction of mines, and now it's definitely in production phase. There was a bit of a dip there in terms of sentiment, no doubt, but the mining industry remains strong.
Yeah, they're hiring again. The stories that just as a West Australian you hear are that they're hiring again. Everybody knows somebody who's been picked up and hired, and they've gone to that higher job, or they're back working, and they're the sort of positive reinforcements that come through. We read the data of the performance of the state, and it just lends itself to a little bit of confidence across the community.
Well, what's the government doing out there? I sort of mentioned beforehand.
They're not doing a lot wrong. I shouldn't probably comment politically, but
it's not a political podcast. But
no. Look, they don't appear to be doing a lot wrong. And when you've got your main opposition comes out before the election and says, "Hey, I can't win," it's actually saying something pretty strong. They're not doing a lot wrong. They're creating jobs for Western Australians. They're supporting that mining industry. They're supporting internal work. They've been hard on things like borders, but that seems to be pretty much supported across the wider West Australian community. And most of us here seem to have the view that as a government, they're not doing a lot wrong. And it's not correct to assume that because it's a Labor government that property will suffer. I've heard that time and time again through my 30-odd year career. Property orientates as long as it's got a firm, stable government. As to whether that's a Labor or a Liberal government doesn't seem to make any difference if you actually look at the facts. I mean, in fact, some of our most prosperous times have been with a Labor at the helm. So, as to whether it's going to affect property, it won't. The stability of the government and the likelihood that they'll get re-elected, if anything, is meaning that your normal hiccup in property investment, normally when you have an election, there's a slow, there's a lull, we won't invest. That hasn't happened. And so the property market has continued to pick up steam, particularly over this quarter, which has been quite interesting, really.
Yeah, and I was looking into the election, and there's a danger that the Liberal Party might not even be the official opposition subsequent to this.
I've heard that as well.
Putting their hands up before election going, look, we're not going to win.
We're not going to win, yeah. It was an interesting move.
Yeah.
But you look, politically, it's a stable, solid environment, and that's just echoing with the confidence and the fact that there is no lull, there's no stop. It's just continuing. People are investing, and probably in greater numbers than they were before.
So everyone sort of joked through COVID-19, this sort of successionist movement from Western Australia out of the Federation. How serious do you reckon that is?
Nah, it's not serious at all.
It's good East Coast, West Coast sort of
it's great banter. It makes a bit of fun, like tackling a Melbourne football team. But I couldn't see any credence or credibility behind that at all. Yeah.
Well, what we do to property prices, no doubt. But let's get into property, Brian. We're just going to go to a break beforehand. Back in a moment.
Are low interest rates impacting on your investment returns? It's time to rethink. Rethink Investing creates wealth for clients through the strategic purchase of positively geared, high cash flow commercial property. Industrial properties, retail assets, or office spaces can be a smart investment option that produces significant and long-term return on investment. Rethink your investment options and look to commercial property. Learn more at rethinkinvesting.com.au. Rethink Investing, Australia's #1 commercial buyers agency.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Brian Sullivan. He's Managing Director of Brian Sullivan Property Consultants that specialise in commercial. So we've got this, we sort of had a wider sort of economic picture outside of mining. And we talk about sort of St. George's Terrace. I think I get my streets right. That's where a lot of the large corporates are based, a lot of them connected in with mining and ancillary industries, so legal firms and all those people who sort of suck on the teat of mining, which is the big driver of the economy out in Western Australia. How's everything else going out there is through COVID-19, tourism, viticulture, all those sort of connected, sort of diverse economic areas of Western Australia? That must be hurting still and smarting. Is that sort of...
Look, I've got a reasonable number of clients in a whole variety of industries that I'm pretty close with. And the farming community are a large part of my client base. So I spend a bit of time with them, and some of the farmers are very big businesses now, and they're doing very well in many instances. So that's a big driver and a big supporter of our economy. And that export that comes from that farm community in Western Australia is pretty impressive. And as an industry, there are, from my point of view, from the outside, they're a really, really impressive industry there. If you're running a farm and making money out of a farm and you're doing a good job, you are a very credible, successful businessman. And so from my point of view, from where I sit and from what I see, I think that our community and our farming is a big driver of our economy. And they're very good at it. They're very successful at it. So,
and this is wealth effect. So people generating, driving income through their business pursuits. And most smart business people I know park their money in property, and commercial property, no doubt, is an asset class.
Yeah, look, dealing with a farming community base, it's a really interesting group of people to deal with because they have a very down-to-earth approach to the way they do things, and they have a great way of cutting through what's nonsense and getting to the heart of things. And I think it comes from the fact that, they have to be so focused on their business, on their plant and machinery, and on making their businesses work that they're good business people. There's no doubt about that. And many of them do invest in property. And going back to the 90s, I can remember running meetings for farm consultants and others who were helping their clients divest into other investments off farm. And I think that those that followed that trend have been very successful business people.
Why are they chasing commercial property, do you think?
Yeah, normally they have a residential base. I haven't met a farmer who doesn't have a residential base in the city as well. They like commercial property. It brings a slightly greater risk profile to them, and generally speaking, provides them with a slightly greater passive income or return, ongoing return. And that return's normally relatively certain, particularly if they spread their risk a bit. They can generate a relatively certain return over a medium to long period of time. And I like that, as most people do in that situation. When you've got an industry that's so fluctuating by demand, by seasons, by a whole variety of factors out of their control, there's something that they can create an income stream that is constant. So that has great attraction to many businesses that have fluctuating income stream. They can create a stream that is a lot more constant, and much more rewarding than, say, other investments. And so that's, I think, one of the main drivers for commercial property for those sort of business people, if that makes sense.
Yeah,
or investors.
Yeah, it's a smart piece of diversification. And everyone talks about Perth sort of since its peak, which would have been sort of the early 2000s, and what has been a pretty flat market from there on in.
Yeah.
And a lot of the reasons why and drove that peak. But most of that's sort of geared towards residential property. What's commercial property been doing out there the last decade or so? You don't get a lot of headlines around it.
Yeah, look, that's true. We probably don't get as many headlines. It's a much more specialised area.
We don't get the headlines out here on the East Coast.
No, you probably wouldn't. But look, for us at least, in what we've done, it's actually been quite a successful little. There have been times where we've chosen to stay quiet and not invest, but we invested heavily, with another company I was with at the time, through the early 2000s. And we held through those really boom, peaky periods and then sold. We started picking up assets again through the 2010 to 15, went quiet a little bit when we seemed to peak a little bit with interest rates have a very direct correlation to commercial investment. Mm. With those interest rates going where they've gone and remaining where they've gone, it becomes quite a hard argument to avoid that the returns that you get when you've got an interest rate of, we're striking interest at 2% and less on our commercial loans. So your gearing rate and you're purchasing at 6 to 7%, that differential is hard to ignore. And so it's driven the prices of many commercial assets, particularly those that are securely leased. So if anything, there's been a driver towards what people perceive as more secure commercial assets, and perhaps a flight away from anything which people regard as more risky or not income producing. So that would be one change in the market over the last 4 or 5 years that I've noticed continuing. There's a greater wedge between what is perceived as safe and what is perceived as risky. That doesn't necessarily mean they're right, but there has been a greater flight towards those two arms, one taking more of the investment than the other.
It feels like when you talk property, residential property, and a lot of people I know, buyers agents, property strategists, every man and his dog's out in WA right now looking for property.
Yeah.
What's it like in the commercial space?
Look, it's pretty similar. Pretty similar in that area where people perceive it to be safe. And we try to operate just above the level where most small superannuation funds can get in and buy something which might be the 2 to 3 million range. And I try to stick to the level slightly below that where the bigger trusts get involved at 20 million and above. We try to stick to that wedge between, say, 5 and 15 or 20 mil. And that seems to be a little bit quieter than the other peaks, the other ends of the market, which are very much in demand. Looking at a few assets, slightly lesser value than normal over the last 3 months, I've been surprised at how quickly they've been picked up. and in some cases surprised at the prices that have been paid for the assets too. So in that lower end of the market, there still is a huge amount of demand, and properties are being picked up relatively quickly by the investor base.
Yeah, are most people chasing yield, or are they chasing potential capital growth?
Yeah, I've seen a flight to yield. I don't necessarily agree with it in all instances. I think you can hide all essence of sins in a yield-based property purchase, particularly if you really don't understand the mechanisms behind what the rents are. And so rents have fallen across the board in a lot of sectors. It doesn't necessarily mean in a commercial property that it's immediately reflected. And so with commercial property, it tends to lag the market a bit. And it lags the market both in terms of its upbeat speed and also in terms of its fall, because those rents don't necessarily revert to market the minute the market crashes. That's both a strength and a weakness. It means that you can be buying a year in thinking that you've got a great secure asset with a great long-term income stream, and the rent won't be replaced at that rate if the tenant ever left. So there is a plight to yield, a sought for yield. It doesn't necessarily mean it's always the right decision. So, as a buyer, and that's where I represent what I do, I'm always looking for the underlying value of the asset, and importantly with anything that's leased, is that rent actually a market rent today? And it's no longer the case that you just accept a face rent and go, yeah, that's fair. The tenant's able to pay that, because they may not be able to pay that moving forward. And that's probably a critical part of your selection process that many people tend to get wrong.
Yeah, I want to chat about asset selection, but just sticking on yield for the moment versus capital growth. I don't know, commercial is a bit different to resi, but most people want both yield and capital growth. And depending where you are in your portfolio and what you're looking for, you might choose yield over capital growth or capital growth over yield. It depends. In terms of capital growth, it's been a relatively flat market in Perth across resi and commercial. What's going to be giving? Is there potential for capital growth? Is it going to happen immediately? Do you think it's going to be a bit of a slow burn to get it up through this sort of next cycle?
Look, I think you can generalise too much. And if we do generalise, and residential certainly is normally focused on your capital return. Any long-term residential investor, and we've had some assets there, realises that, as a rental income stream, once you take into account the fact that tenant A destroyed the joint, tenant B did a runner, and tenant C left you with replacing the carpets, your actual returns they melt away pretty quickly. Commercially is a lot cleaner than that. And so if you might be working on a 2% return on your residential, you're generally speaking on a 5 or 6 on your commercial in terms of your regular cash flow. It's in your bank account at the end of the month. Now, you then arguably expect that the lower returning residential will show you a higher capital growth, because that's why you buy it. So you're buying residential because it's a more stable investment. You believe it's going to offer you a higher level of capital return. And generally that's the theory, it's the philosophy, and it's pretty tried and true. But in sections of the commercial market, you can actually receive quite substantial capital growth as long as you know what you're buying and you pick it well and you have some foresight, and hopefully you get it right. So even in what you might term is a quieter environment, if you looked at the Perth office market, you'd be decimated. But if you were buying bulky goods in 2010 to 2014 and an 8 to 10% yield, you're now sitting on assets which have had rental growth, which have had their 8% return per annum, maybe rising with rental growth, and you're now sitting on assets which would sell for a 6 to 7% yield. You've effectively doubled your equity. So your capital growth has been outstanding. Or if you were sitting on industrial assets, which you always traditionally picked up at a substantially higher yield, you might have been talking traditionally a 10 to 12% in the early 2000s and probably 8% around about 2010. Those assets are now selling for a 6% yield on rent. Again, that doesn't sound like a lot, but you take your maths and your couple of $100,000 rental income and you divide it by 0.06 instead of 0.08, and you're sitting on substantial capital gains. Yeah. And so it's not correct to necessarily expect that the entire commercial sector has been affected in the same way. And the industrial sector has been driven substantially by our mining, has had some substantial growth. And substantial growth over that period since 2010. I actually expect in some sectors that will continue. You just need to be careful and pick your sectors right.
Yeah, well, let's chat asset selection and sectors. We'll go to break before I'm back in a moment.
Whether you're a seasoned property investor or about to buy your first property, Finding the right investment property to buy in 2021 isn't easy. Why do it alone when you could partner with award-winning buyer's agent Paul Glossop? Over the last 10 years, Paul has helped hundreds of clients build multi-property portfolios. Paul's secret is finding off-market bargains that get snapped up before the general public even gets a sniff. Interested? Head to purepropertyinvestment.com today to schedule a strategy call with Paul Glossop.
Welcome back, everyone. Phil Tarrant, Smart Property Investment Show with Brian Sullivan from Brian Sullivan Property Consultancy. He's the managing director there, talking all things commercial property out in Perth. You touched on Perth office markets, mate. You might take a bit of a haircut there for a little while, but tell us what you like at the moment. Let's go through the 4 different types of assets: commercial, industrial, retail, and some of the specialty stuff. Let's kick off with office. Give us some insights into...
Yeah, look, I probably wouldn't.
Let's say Perth again. There's not really much else outside of Perth except for some sort of small regional centres for office.
Yeah, look, I'll probably run you through my philosophy, and I'll keep. I don't invest regionally. I think that we're already in a fairly remote part of the world, and I prefer to keep our investments metropolitan based, simple. And if we invest, so it's metropolitan. We haven't traditionally invested in the office market. I philosophically, long term, haven't ever really felt that people needed to be working in that office environment to the degree that they have. I suppose COVID's proven that point more than ever, but I personally haven't really seriously looked at the office market as a market that I felt had great growth. Even when I was wrong, I wasn't worried about missing out. I predominantly focus on the industrial, retail, bulky goods markets, and I tend to keep away from more tourism specialised markets. So over the last 4 or 5 years, our focus has been on bulky goods, where I felt that main road frontage.
For us, a lot of people might not actually...
Yeah, bulky goods, we're talking about your alternative retail. We're talking about those large showrooms, your Bunnings, your Good Guys, your Harvey Normans. That's sort of an area, that's sort of a retailing. And for whatever it's worth, I felt that there was some growth in that sector, and we bought reasonably heavily in that sector from 2011 through to 16. Moving forward over the last 12 months, we've looked for more commercial assets along the lines of child mining centres. We like medical. We like that sort of commercial use. Again, we're normally looking at assets that have main road frontage, have reasonably affluent or growth potential in the suburb, because that's always important for commercial. If you have a growing residential suburb around it and they're affluent or they're younger where they spend a bit more money, it tends to lend itself to support those commercial businesses in the precinct. And so we're looking at sectors of that nature, and with a bit of a move back towards the industrial sector, as I think the rents now have flown through. So where there have been reductions in rents, for the main part, that's flown through, and the market now has an understanding of what a fair rent is. And for the first time in a very long time, we'll be looking at some of the neighbourhood shopping centres again. That's an industry and a sector that I've had a huge amount of involvement in the past, and it's pretty dear to my heart. We've steered away from it for a while because of the effect on the specialty stores and the change in retail. But it's reached a stage now where I think it's worth reviewing that sector, having a relook at that sector, and possibly picking up an asset in that sector.
So neighbourhood shopping centres, are you talking sort of shopping malls, or are you talking strips? Or
prefer decent trading supermarket with a small number of specialty stores. The days of a supermarket supporting 20, 30 specialty stores, I think, are long gone. In the days of a myriad of small stores, like a marketplace stores, where are not going to reinvent themselves, but a small-based supermarket supporting a handful of stores, newsagent, pharmacy, medical, child mining. There's growth there, there's potential there. And I see that that's probably a market that I'll be starting to look very heavily in over the next 3 to 6 months.
Is there much of that stuff around? Is it rare as hell?
No, it's hard to find. You've got to pour over it. And then you've got to, normally you'll be doing a bit of work to get it up to speed, but it's there. And property, there's always another one. It's a bit like a bus. There's one down the road. You're not going to miss out. Just keep to your...
Who's selling that stuff at the moment? I imagine...
Yeah. As with any market, it's many people have that sort of asset, go, what am I going to replace it with? And why would I sell? But there are always reasons for sell. There's age, There's changes to lifestyle. It's actually a fairly intense asset class to manage. And, people get tired of constantly managing and being on top of a pretty fluid environment. And not all of them can do it well as well. So you have a variety of reasons for sale, and there'll always be somebody who, for whatever reason, gets to the point in their life where it's time to move on, to reinvest, to change. So again, I've never had the view that you should be pressured into feeling compelled to make an investment decision on the fear of missing out. Yeah. That just isn't the case.
Well, I'll tell you what, there's a lot of that happening right now. Just, watching auctions out here on a Saturday in Sydney, you're getting 70, 80 people sort of rocking up looking to bid at an auction. And a lot of that is FOMO, right?
Look, I'm seeing the same, man. And, if I could give a little bit of advice to anybody, don't fall for the fear of missing out, Yeah, they do. But, don't. It's not something that I subscribe to.
Yeah. So how do you work, Brian, with your clients? Are you sort of, what do you call yourself? Are you a buyer's advocate, a buyer's agent for commercial?
No, look, I'm straight into investor. And the way I work with my clients, and I come from a property buyer's background, property agent's background, property syndicator's background. So that's my background. And 10 years ago, I thought, there's a better way to do this. And the better way to do this is simply that I want to make my money and my investments grow. And if you want to invest with me, do so. And so our philosophy is simply to choose the assets that I personally will invest in and do invest in, and then invite my client base to join me. And I'll try to keep everything as close to a true property investment as I can. If you watch the property trusts through any of the stock market collapses, you'll see that they actually perform just like any other share. If you look at property, it performed differently. I'll say better or worse, but it performed differently. So if you make your property investment as close to a direct property investment you can for your clients, it's going to perform just like property does. And so that's been the whole philosophy. If I'm going to invest in this category of property, which is slightly more risky, it's commercial property, it's quite specialised, let's make it perform like a commercial property does. And so the trusts are all very, very vanilla and straightforward. We buy the property in a trust name. Investors invest into the trust. There are no special fees. We charge a management fee. We charge an acquisition fee. We charge a selling fee. There are no bonus payments. There are no special performance payments. It's really kept quite vanilla, quite low key. And my return, the largest part of my return, comes from the amount that I invest in that trust alongside my other clients on the same basis as my other clients. So I kept it really very clean and very straightforward. And the philosophy of it was simply, I've done this for 20 years at the time, now 36, and I've seen and I've watched good investments, I've watched poor investments, I've helped people. It's now time to actually grow my own wealth through what I do.
Why not?
And that's been the philosophy over the last 10 years since we started. And it's the only criticism I've got is that I don't do enough. And that's because I don't have the fear of missing out. I'm happy to sit on an asset performing really well rather than rely on syndicate fees because I have to do 3 a year.
Yeah.
We buy what we want to buy. We manage it ourselves because we know it's more important to us. So if a tenant hasn't paid a rent, I bloody well know about it. Oh, sorry. I know about it because, it goes to my bank account. I remit quarterly to my clients. If they want to see me, they can walk in. If they want to speak to me, they can ring up. It's a much more, there's no point being the same as every large syndicate or every large trust manager in Australia.
Yeah, and syndication, for those of you who aren't familiar with it, we wrote a lot about it on smartpropertyinvestment.com. So you go and check it out. Do you think, Brian, is there a point when a syndicate gets too big? Where's sort of like a nice sort of safe operating zone for most investors? Because
depending on it, there is.
Like a little bit too big.
Yeah, look, it's a very personal view, and to me there is. So I keep everything at under 30 people, under 20 to 30 people. Keep it to a manageable level where you can actually ring me up. We can have a syndicate meeting and people will turn up. Not many people do that, but you normally speaking, when you're investing in commercial property, your profile isn't that great. You're not going to get a 20-year-old. Well, I won't at the sort of levels that we're putting in. You're going to get somebody who's made a bit of money. They've got a few clues. They shouldn't be putting all their nest eggs into it. And they want to be able to have direct access to the guy who's making those decisions on a daily basis. To do that, you can't be, from my point of view, you don't want to be one of a couple of hundred. You want to be one of 50 or one of 20 or one of 10. Yeah. And so that's the way we've structured ourselves.
And most people are pretty passive. They're sort of, once they, I imagine no doubt people sort of try, give it a go and it works for them. They go, okay, what's next? Tell me the next one.
Yeah. Yeah. Look, the main part. I
know a lot of people that sort of invest in syndicates like this.
Yeah. Look, most guys test you. Most people, because I've got many. Most people test you. They'll give you a little bit. They'll come and meet you. They'll check you out. They'll watch your reporting. They'll watch your results. And then you'll notice the next syndicate, they might invest a little bit more. Many of them have got their own holdings, and they take the view that this is their manner of just increasing the number of assets that they can invest in. So rather than having every nest egg in that $3 or $5 million property, if they put, a couple of $100,000 in 4 or 5 of my trusts, they've got exposure to a wider cross section. So many of them are pretty savvy investors in their own right. They just can see the benefit in perhaps spreading the risk a bit.
Yeah, so a lot of people think this is new. Like, there's all these new apps that are out there where, young millennials can invest a little bit here, a little bit there. Like, this has been going on for hundreds of years.
This is not new. This is not new.
Not new by any means. What's the exit for those people? How do you get out once you get in?
Yeah, look, property is illiquid and commercial property is illiquid. So we tend to structure our trusts so that they're between a 7 and 10 year hold. And so you get out at that point. You can get out earlier. The truth of the matter is there's normally always a market for your shares in the trust as long as everything's going well. When everything's going well, nobody wants to get out unless there's some sort of issue in the family. If there is an issue with the trust, and it doesn't happen too often, but if there is, then it's hard to get out. So generally speaking, my advice to anybody looking at a syndicate is understand the length and term of your investment and be prepared to commit to that, because property is a long-term investment. True property is not something you buy and you sell within 12 months. So you go and do something else.
And you distribute on a quarterly basis.
Yeah, we personally we distribute quarterly. Yeah, and it's a regular.
You don't do any borrowing against it? It's all just direct cash?
No, we do. The borrowings in property has a really important role, and you got to use it selectively and use it properly. We do use borrowings. We keep those borrowings down to under a 50% ratio, and I tend to pay down debt when I can, as long as it's not affecting the expected returns from the investors, which held us in phenomenally good stead come March 2020 when you had many tenants unable to pay rent. We were not pressured on any of our trusts or syndicates because we had low levels of borrowings, and on some of them we paid down debt substantially over the more successful intervening period before. So, yeah.
So what sort of debt structure are you using with that sort of stuff? Pretty traditional?
Non-recourse, very traditional. Non-recourse, major lender, interest only.
Okay.
Full stop. So we're not. One of the main things with any syndicate is you should not ever be guaranteeing the performance of the syndicate as an investor, and you should not be guaranteeing your partners. My structure is always very clean, and the only recourse the bank has is that property. So if you put 100,000 in or 500,000 in, you're risking that amount of money. You're not going to be called upon to put another 100,000 in because the bank have sold it for less. You got to understand your risk and quarantine it as best you can.
Yeah, and on that note, we chat a lot about resi property, but also commercial, and it's a very different playing field if you actually want to start considering investing in commercial property directly. Most of us, if we've got a super fund, we're probably all holding some sort of commercial property somewhere or other. But direct property investment or via your self-managed super fund by yourself, or you can start getting in this syndication. But maybe not where you'd start off. Your first investment would be in a property syndicate. Do you reckon sort of get some resi first, Brian?
No, look, I wouldn't necessarily go that way. Look,
you say that?
If I was a young bloke, a young person, I'd always tell them to get their house in order, to buy themselves a house, and and that's a different philosophy. That's a place to live. That's a roof over your head, and get that paid off. And work hard. We were always told, bite off more than you can chew and keep on chewing. I don't think that advice would change. When you get to the age of life where you can invest, well, then weigh up what you want from that investment where you're at. And it might be that putting your money in shares is the way to go. It might be that buying that extra residential property is the way you go for capital growth. It might be that you actually are at the stage where there is a more of a focus on income, in which case have a look at commercial property. And if you have an association or a relationship with somebody who does it well, there's nothing wrong with being part of a syndicate. It is a way of letting somebody who really knows that sector well do what he or she does well, and just don't put all your eggs with them. Test them. Yeah.
Oh, that's pretty reasonable advice, mate. Or recommendations. We don't give advice here on the Smart Property Investment Show. I'm just a journalist. I don't give advice, but recommendations.
I need to be careful there too, don't I?
So, hey, Brian, if anyone sort of wants to track you down or find more about what you do, how do you do that, mate?
Yeah, look, we welcome that. You can contact us via our direct line, which is, I can give it now if you want.
Sure.
Yeah, you can contact us via our direct line, which is 08 9438 1599. You can log on to our website, which is sullivanproperty.net.au, or give me a call on my mobile if you want. Yeah.
Nice one. Well, thanks for your insights, Brian. It sounds like it's not a bad place to be investing in property at the moment. Can you give me a sort of location within Perth before we leave? Where got to give you something.
Yeah, location. Look, we've invested reasonably heavily.
Geographic area then.
Yeah, okay. We've invested reasonably heavily in the southern region, which runs from Fremantle down through to Mandurah. That's been an area that perhaps isn't as sexy as the northern region, but I think there's a bit of growth through that section. Yeah, and I think if you were looking at geography, if you're looking at type of property, you might want to stretch your mind to some main road commercial or retail over the next year or two.
There you go. You got it. Brian Sullivan, Property Consultants. Brian, thanks for your time today, mate. Appreciate it.
Pleasure. Thank you.
Hope you enjoy that, everyone. Remember to check out smartpropertyinvestment.com today. You'll see a big sort of thrust of ours to dig a bit deeper into commercial property. That's in response to a lot of our listeners who are asking for it and a lot of our readers on smartpropertyinvestment.com. So we'll do more of it. Got any questions at all? You can contact the team here. We'll try and get those questions answered on air to editor at smartpropertyinvestment.com.au. Social media, you can find us at Smart Property HQ for headquarters. I hope you enjoy these podcasts. If you do, a big favour for me, it's the team get a real kick out of those reviews coming in wherever you listen to us, whatever podcast platform player that you use. That'd be great. Let us know what you think. We'll be back again next time. Until then, bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.